Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode, we are speaking with Michalakis, Chief Investment Officer of Funds SA, which is a $50 billion investment manager for South Australian public sector superannuation funds and other approved state authorities. Con is well known in the Australian investment industry, not in the least for his outspoken views on a variety of investment topics, including gold, crypto and asset allocation, much of which has historically found the limelight through his notorious Twitter or X feed. We trace back to Con's roots as a quant and value investor and discuss how this continues to shape his current investment philosophy, despite the fact that he calls himself now an ex-quant. We discuss the changes in governance and the implementation of a TPA Lite framework at Funds SA, while we also touch upon the turmoil in private credit. Finally, Con admits that he was wrong about innovation and disruption being the most dangerous words in investing, while he stands firm on his dislike for crypto and dynamic asset allocation.
The idea that you're going to do dynamic tilting or that you're going to do overlays on top or you're some sort of macro guru, I call that the Comic Con, right, of asset allocation. Everyone dresses up in their favorite character. One's a dynamic tilter, one's a post-Keynesian, one's a Keynesian, one's a value guy, one's a trend. Great. You can have it. Yeah, you're not going to see us trading frozen concentrated orange juice and pork bellies.
Con, welcome to the show.
Good to be here. Thank you for inviting me.
No worries. So I want to take you back all the way to the beginning to get sort of a sense of your thinking on investments. And I believe you studied mathematical science in Adelaide, then went on to do a master's in financial economics in London, and ended up at the Oxford Said Business School. So there's sort of a combination of, purely mathematical thinking, but also strategic thinking. How has that shaped sort of your outlook on investments?
Yeah, sure. So I would say I'm more of an ex-quant now. I mean, it's a long time ago since I did option pricing and was a quant. So, but still a numbers guy in terms of how I think about it. And to be honest, the younger people that I've worked with, whether it was at Statewide, Hostplus, at Funds SA, they're brighter, they're more technical, they're more up to speed. So they've way taken over. So I would call myself ex-quant. Still think in terms of numbers, still pretty STEMmy, and there's a bias across all three firms that I've worked for sort of STEM type thinking, science, technology, engineering, maths, but you can't just all have one. I have now believed that you can't just be one grade. I still think you can take STEM people and teach them finance. It's hard to take finance people and teach them STEM, but you need all sorts. And some of the best thinkers are not necessarily the way they think and critical thinking. They're not always just STEM types. I've learned to embrace more diversity in that. And interesting, some of the managers that we've invested in, they come from interesting, historians. So you got critical thinking is more important, but yeah, definitely a bit of a bias to STEM.
Yeah. So how would you describe your investment style now then? Because, of course, you mentioned three firms. You worked at Pacina for a while, which is a value shop, a deep value shop. Do you still have some of that thinking as part of your DNA? Or are you looking more as sort of a contrarian investor? I think,
So in my heart, I'm still a value person and a contrarian. Like to invest at the margin in areas that are either unloved or where capital is scarce, because highly likely the risk is that it hasn't been priced in and therefore there's a trade-off. But definitely call it the maturity cycle, diversification, the ability to invest long term and make sure you have investments across a broad range of strategies and asset classes, and not being sort of, across the cycle, not having one dominating, I think is very important. I've learned that lesson, and it's a lesson that I know. But in my heart of hearts, if it's contrarian and value, it's probably my kryptonite.
yeah. So you learned those lessons. Can you give an example of some of the things, some of the trades maybe that taught you those lessons?
Yeah, probably bond allocation, fixed income, like if you look at the Japanese bond market, it was the widow maker, you didn't like it at 4, didn't like it at 3, 2, 1, 0. Oh, it's come back now. So, maybe the mean reversion took 30 years, but it's coming back. You got to be a bit more smarter than naive mean reversion. Value investing, there's been a statistical value risk premium over 100 years, but arguably it's been very choppy and hasn't worked since the GFC or prior to the GFC. If your portfolio, if you're running a diversified multi-strategy, multi-asset portfolio, and you've let one style dominate your over a cycle, you're going to outperform or underperform because you're too biased to that. At the margin, though, so remember, you're running a world diversified fund. Occasionally, you get thrown niche strategies and ideas where either the market has unloved it or there's an opportunity to extract return. That's pretty good. So, we were a bit late to that at Statewide, definitely at Hostplus when we did the sort of insurance-linked strategies with quota shares. We did that last year here too at Funds SA, and that's done really well. In the small and mid cap, where managers can probably do a little bit better. Venture capital, when that was unloved 15 years ago, we were late to that at Statewide, but Hostplus was very good. So you wanna be diversified, but you want to go to early areas and adopt that if you can.
So looking back on that, what does that mean for the portfolio? Is there still a place for value, or are you more a style neutral guy now?
There's a place for value, and be conscious if you're going to use a combination of passive, quant systematic, and traditional fundamental. You want to be conscious of and how your managers are managing that. Some are core, some identify as value, some are identified as quality or growth. You want to be conscious of what you're carrying into that portfolio, except particularly in this, incredible market movements that we've had probably since COVID, for lack of a better word, that you're going to have dispersion. And that gets down to beliefs. Can you ride the cycle? Do you have the ability to, if you have good relationships and you trust your managers, to reinvest when there's their style, or, there's always a style that they've had an issue with a couple of stocks. Do you have the backbone to just stay in the game with them and reinvest?
Yeah, you just mentioned that COVID period. Do you have any sort of lessons from that? Did you change anything in the portfolio to deal with sort of that volatility?
When I joined Statewide, it was a GFC. So,
yeah.
so I left Pzena. It was, a couple of weeks off, and joined Statewide. My first week, that weekend, Fannie and Freddie was nationalised at the end of the week.
Yeah.
The week later, Lehman went under. Now we're in the GFC.
Yeah.
And that was painful. So really from September 2008 to April 2009, this was one of the most acute periods of investing I've seen. Now, I saw when famously Westpac had a failed rights issue early on in my career, and I think it was Kerry Packer had to bail it out. We've had Asian crisis, 9/11, but this was up there with one of the worst I've ever seen. And Statewide was in trouble. It
Yeah.
really didn't have a diversified portfolio, didn't have a lot of cash or a lot of bonds. It had to pay hedge by selling equities. Luckily, Chris Williams had joined me, I think October and November that year. So Jimmy Vernon Payne, who's now a consultant at Jana, Bill Watson, I think he's at First Super, or is he moving to? Yeah, I think something like that. And all of that was happening live, and we had to manage that. And that was a really difficult period. We had to write off assets. We had to rebalance the portfolio. We had to put in governance structure. We can talk a bit about that later. That was a doozy.
So that was a heavily equity-focused portfolio.
That was a heavily illiquid portfolio, but more importantly, it didn't have cash or bonds.
Yeah.
We didn't have any fixed income. Even fixed income was a bit of a savior. The Aussie dollar collapsed, so the international allowed you to, but international fell by more. So that was a difficult time, and that taught us the importance of the diversification, liquidity, managing portfolio shape, not for currently, but looking out forward, and having a risk management system in that you could understand and also live by. I would say, though, by the time we merged with Hostplus, we were one of the top 5 or 6 performing balance funds in the country. In terms of peer surveys, Your Future, Your Super, we had the best Aussie equity numbers over most time periods, the best fixed income numbers. Pretty proud that by the time we had merged with Hostplus, we were one of the best performing funds in the country. But that initial 6 to 9 month period was hell.
Yeah, I can imagine. I mean, I had in there that, like, you must have done something right because you survived for 40 years after joining Statewide.
Well, ultimately, the central banks and the unbelievable amount of QE and reinvestments and bailing out the financial system. One of the first responders was the Aussie dollar rallying, and we kept the hedge, and we used those hedge gains to rebuild our asset allocation. And then, frankly, equity started recovering. I think by May, it bottomed out and it was on the rallying. But yeah, for that period, it felt it was uncomfortable. Now, COVID, so by the time we got to COVID, we were so well diversified. We had risk management planning, we had liquidity ratios, we had stress testing in play. And it was only for a week. I remember it was pretty late nights, early mornings, late nights. Chris was then the deputy CIO. Chris Williams, who's now at Hostplus, was the deputy CIO. And I remember was one morning, Chris goes, "Okay, now I'm worried. There's no market. There's no market in bonds. The market was unruly." And I remember being on the couch one night, and I was sort of had Bloomberg on, and I saw this big headline, "Unlimited QE." And I remember saying, "Okay, this is done. It's over. The markets will respond."
Yeah.
So COVID was short in terms of the bounce back. What was then hard for most super funds was early access. How would people tap into super? How would you manage that? We were moving then to weekly investment committee. We had a risk scorecard checklist. We were going through valuation, scorecard, stress testing. I actually thought we played that well. What surprised us was how quickly the markets bounced.
Yes.
And we had underperformed just, in that immediate period. And then there was a vaccine that was announced. We had quite a few value strategies. They did really well. And then we came through.
Yeah.
By the time we merged, performance was pretty good.
So it sounds that in a number of these like tricky situations, liquidity was a central theme in sort of trying to manage the risks in the portfolio. Has that sort of changed your ideas on how to manage liquidity, and also in the current environment where it's quite volatile, very concentrated markets? What is your philosophy towards liquidity?
So front and center, the big changes we've made at Funds SA was governance. We've set up, there was a lot of meetings here. So there was a lot of meetings, there were a lot of people in meetings. We've tightened the meeting schedule. There's less people at the meetings. We've broken down silos, and we've introduced concepts like, okay, we've got a proper investment strategy that embraces diversification. We've got liquidity ratio and stress testing. We've got fee budgets. We've got active fee risk budgets that we're implementing. And so we spend really the first 4 or 5 months of every year updating our investment strategy policy, making sure it's fit for purpose, and then basically the rest of the year reviewing the asset classes that are sympathetic to the overall investment strategy. And in that risk portfolio shape, managing the portfolio, not for today, but over the next 12 months, we have an unlisted forum that goes further and making sure we've got enough liquidity, what's our FX hedging policy, terming out hedges, making sure if markets move, we can take advantage of what's happening. And that served us really well at Statewide. I know it served Hostplus really well, and we're off to a good start here. Ending March financial year to date, I would say our balance funds in the top quartile. Early days, 9 months and 1 year. I've been here 14 months, but having a risk management lens and shaping the portfolio and no more silos is a key part.
Talking about risk management, I've heard that you used to have a photo of Trump on your desk to remind you of risk. Did you bring that to Funds SA?
No, I see enough of him. I see enough of him everywhere, whether it's news or media. I don't need a photo. It was a joke. I think the team went to some charity and they got a MAGA hat, and I had a photo of him and Putin, I think, on my desk, which was good because 2016 election was unusual. If you remember how markets traded, they priced a Clinton win and then a Trump win, and the reverse was like a bit like Brexit, actually. And so, no, I see enough of him, and I see enough of his policies, and I see enough of the reactions to the markets to tweet. So he's a constant reminder. I don't need him.
Yeah, you don't need to be reminded of that. So you mentioned that setting down a proper governance framework was important in sort of reshaping the portfolio at Statewide. Can you tell me a little bit about what you think are the essential ingredients of that governance framework?
Yeah, sure. And it starts here with Funds SA. So, 14 months in, what did we do? Start with the basics. We actually wrote a plan. I wrote a plan for the board. And what we said was governance, strategy, team structure, and within Jana coming on as a fuller service asset consultant. I'd worked for Jana for a number of years, and they've been a great partner. I don't consider them a service provider. They're a partner to us, and we basically rest on their shoulders. We don't have to make things. We can get a lot of their IP and thinking and basically build on that. In terms of governance, it was recasting the investment committee. There's now a smaller investment committee. We have an independent chair, David Holston, who was my asset consultant, then retired, then joined Statewide as the chair of the investment committee and board member. He's here as an independent, but making sure that's in play, doing things like investment beliefs, having detailed asset class reviews, bringing the team together. We have a weekly portfolio construction forum where there's the investment strategy team and the asset class heads. Once a month, we invite Jana as well to that, having papers prepared, going through the shape of the portfolios, what's happening in the markets, trying not to be short term and managing this for the medium to long term. That's been probably the biggest changes here, plus the usual, introducing liquidity ratios, thinking of risk, thinking of how you're going to diversify the portfolio, and being small enough to take advantage of strategies and ideas should they present themselves. They don't often, and we don't think we can trade our way through it, and we can talk about DAA coming up, but just being aware and being able to execute quickly.
Before we jump into DIA, I want to talk a little bit about Funds SA in sort of the broader investment industry here in Australia, because it's relatively unique. You have worked at a super fund as well at Hostplus. Obviously, they are subject to a whole set of regulations where they need to pass a performance test on the Your Future, Your Super. That has influenced how they allocate, especially on the passive active side of things. At Funds SA, you don't really have those restrictions. Does that give you an edge or an advantage in finding opportunities that super funds
Sure,
potentially
yeah.
lack?
So we're about 50 billion in assets, and over 90% is the local state pension scheme, for, Super SA, that we run money for. It's regulated by the state, so we're like a state sovereign, if you want to, in that sense, and it has constitutional protection, which is a unique feature. I do think not being having different, being regulated by the state, we have unique and we have some unique tax advantages, gives us a bit of an edge. We can think about how to invest the portfolio. We still shadow, for lack of a better word, we still shadow do a your future, your super. We think about the risk we're taking from that lens, but we can free ourselves from the day-to-day regulatory of an official APRA burden, for lack of a better word, and that gives us, I believe, some unique advantages that we can exploit.
Yeah.
That doesn't necessarily mean that some advantages can be also a ballast, because it's active management is difficult. Can't just blindly do it. It hasn't worked for a long time, and it's particularly recently, it's been a very difficult area. And one of the things we did in the previous review is we had pretty large active tracking error budgets that was purely active in Aussie and global shares. We've basically cut that down by a half to almost 2/3.
Okay.
And one of the reasons is we've introduced passive, we've introduced quant systematic, and we have an active sleeve, and we won't let it go. Just so we again, diversification, even within Aussie or global equities, you can't be full one or the other.
Yeah. So is that active component more now of a satellite allocation? Is it a relatively small part?
It's more sort of, core satellite approach. So the active might be a bit more satellite. You can have some style neutral managers. You might have some small to mids value or quality growth, but we manage that within a mix, and our tracking error, is moving. Maybe in the past it was in the threes, it's now in the 1.5 at both Aussie and global equities.
That active passive element is quite interesting in the light of the current environment, because we've seen, equity markets more or less rally for quite a number of years now. Concentration in markets, which makes active management quite difficult. But if we were to see a flip or some sort of recession, that's often where active management shines as well, where they can reduce sort of the downturn. Are we setting ourselves up for failure in that sense, because we're moving away from that active element, and then when a crisis happens, we might not have enough of that?
I mean, we were pretty active at Statewide. We had quant working very well in Aussie and global. And as I said, global, by the time we'd finished that, net of fee alpha was pretty good. Aussie was unbelievable. It was, I don't know, closer to 2%. I would say to you, the world's changed. There's faster money, there's pod shops, there's instant reaction. We've seen it even, look at between March and April. You've basically had equities, fall anywhere between 5 and 8%. And in the first 2 weeks of April, they basically come back. And in coming into the third week, we're now setting new all-time highs.
Yeah.
So the fast money response, and what I believe is that you have to embrace dispersion across styles, strategies, and managers. And in this world of faster money, moving money, you probably want a bit of everything. And the idea that you can be totally active sounds romantic, but I think the path dependency will kill you. The idea of being totally passive, we have some tax advantages that doesn't totally make sense to be totally passive. And the idea of being totally systematic, well, fine, but there was a thing called a quant winter in 2007.
Yes.
And these things will happen. So why not have a bit of everything if you can? But be careful, set your tracking error budget, set your allocations, and try not to. One of the things I think that could be happening in the industry is if something's not working, they're closing it down. And then they're just going straight to this that's working. Well, okay, that's creating flows and opportunities. when that sort of stops, that's going to create some opportunities on the other side. And I think the other side of that could be an environment where active managers who are targeted and doing well will do better.
Yeah.
They have to prove themselves, though.
Yeah.
They're the great. Well, it's going to get better, great, get better, but they still find new ways to disappoint.
Yeah. Yeah. So as part of that move towards more passive, basically reducing tracking error, but then we see funds doing a little bit more on the dynamic asset allocation side, where partly is sort of trying to implement some total portfolio thinking, putting trades on top of the portfolio that are almost a little bit hedge fund like, relative value trades, global macro trades. What's your view on that? Is that something you're doing?
This is going to be fun. So one of the things when I came at Funds SA is that there was a lot of silo behavior. So there was the asset class people were doing their own things. Then there was sort of an overlay doing their own things. What I brought is everyone's in the room once a week, and we're thinking of what's the long-term strategic asset allocation. Now markets move, so you move away from that. What's the commitments to, if you've got private capital investments, whether it's equity, infrastructure, what's being drawn down, what's being distributed. There's foreign exchange movements, how you should think about the foreign exchange. There's also demographics, there are flows in, there are flows out. There's switching as well. And so I come across from I'm going to call it TPA Lite.
Yep.
So I come across from a total portfolio, what are our exposures, where would we want to be? And if we don't really have strong ideas, run them very close to the strategic asset. After all, it gets reviewed every year, right? We've spent a lot of time spending that as a lot of research time looking at that with our asset consultant. The board adopts it early in the year. And if we don't have an idea, stay close to that. Then markets drift and it's all about the rebalance. The idea that you're going to do dynamic tilting or that you're going to do overlays on top or you're some sort of macro guru, I call that the Comic Con, right, of asset allocation. Everyone dresses up in their favorite character. One's a dynamic tilter, one's a post-Keynesian, one's a Keynesian, one's a value guy, one's a trend. Great. You can have it. It's all yours. I just think it's noise, and good luck trading that in the last 3 or 4 months. In fact, good luck trading that since Liberation Day.
Yeah.
And good luck trading that since COVID, because how many people would have told me bonds went from 0 to 4 or 5% and equity markets set new all-time highs? So I think we take a broader portfolio lens, manage that from a portfolio construction level, figure out where the opportunity sets are, allow a little bit of flex, but yeah, you're not going to see us trading frozen concentrated orange juice and pork bellies.
So do you see DAA as a form of market timing too?
Yeah, they can have it. I've heard about other funds, they do SAA, TAA, DAA, macro thematic. Yeah, all yours. It's up to negative. Good luck to them.
So I had taken you as a little bit of a TPA cynic, but obviously you're not. You
not totally a TPA cynic. I read the study and I did start at Watson White and there's the Thinking Ahead group. I think the ideas of TPA are good. The complete adoption to be, I'm going to be the purest TPA, and I know there's been some great funds out there that have done it. That's theirs. I live in a world where we have different clients who have different needs. We have one client who has a sort of an absolute hurdle, cash flow for 30 years before it goes negative. I have super clients who are, they want us to manage a CPI. They want to manage against peers. They're switching in between funds. There's demographics. I look at everything not just through a pure TPA. Call it TPA Lite.
Yeah.
And, that study that showed all the TPA funds out before, I had a good look at it. It felt a little bit like, nothing against some of my old carnivals, that looked a little bit like consultant slop.
Yeah, I looked at that report as well, and I think they came up with 180 basis points or something. But it seemed to be just an aggregate of the funds that were included in that group.
Slight survivor bias, right?
The survivor bias, but also not necessarily relating it back to TPA. It's just, here's a group of TPA people. And I think there was even Swedish fund in a AP7, I think it is, which is, to my knowledge, a highly geared equity fund. It's not quite comparable.
We look at portfolio construction across the thing. We think about what are we doing to diversify? What are we doing to beat objectives? Sometimes your illiquidity mismatches on what's a good proxy. Where's the actuals? Like you maybe want to have some more linkers than nominals in your bonds at the moment because it's working a bit better within your overall fixed income allocation. That's how we think about it. We want to term out our hedges, but the idea of being pure TPA Lite or pure what's your equity equivalent ratio, yeah, you can have it. Whoever does that, good luck to them.
Yeah. Do you think that is to a degree related as well to how large the investment team is? Is it easier to do TPA and sit around the table in a relatively small or mid-sized team?
So I've been very lucky that within Statewide, Hostplus and Funds SA, we have relatively small teams. And I think that means there are no silos. That means that we can be far more sort of linked up, to use the term, in terms of how we're building portfolios and have the key people, the discussions in the room.
Yeah.
I think that's an advantage that we enjoy. We obviously use external managers. We do the implementations internally, of course, but it allows us to just think a bit and build portfolios as opposed to trying to manage a lot of people.
Yeah. I think in a past interview, you sort of stated the importance of stating your opinion and letting the board know what your thinking is. Is that possible in every organization, or does that need to be created, like a culture created around speaking your mind?
Again, maybe luck. All three funds I've worked for, boards wanted trust and transparency. The Funds SA board, it's 7 individuals. It's an incredible board. And one thing I enjoy, from the chairman, John, the CEO, and our board members is, obviously I'm not a shrinking violet, so they enjoy the two-way communication. And I think they want transparency, and with transparency, you can build trust. And so they like the fact that we can have these discussions. Same at the IC. I do think smaller committees allow us to have better conversations. So the board is, myself, the deputy, CIO, and whoever's presenting if there's an asset class. The IC, there's John, myself, and David Holston, the deputy, Kelly, who is sort of like she makes the trains and run on time in the implementation group. And it just, Jana's at these meetings, it just allows good discussions, ample time to have that. And you build trust because they know what you're thinking, you know what they're thinking, and you get, I believe, a better outcome.
Yeah. Now, Funds SA has gone through quite an evolution in recent times. Apart from the organization growing quite rapidly over the last couple of years, you also had a new chair in Guy de Bell. You had a new CEO with John, although John Pitio has been there since 1995, I believe.
Yeah, so I think it's 2 years, so relatively new.
Yeah.
So John, Guy, there's a couple of new board members, there's been a few new executives, obviously new CIO, new deputy CIO. We've added to our implementation team where Kelly's almost like, she's like our COO within the investment team.
Yep.
I do think it's a sense of renewal, but I'm probably not the right person because it's 14 months. But I gather that over the last 2 years, the Funds SA has changed. It's in a sense that it's more focused on investment returns, clients are important, and the people who are responsible for managing this business. So wrapped around making sure we've got appropriate, it's really good data and tech that we have here. So yes, I'm part of that change. I think investments has changed a lot, and the team has done a good job. Really, I mean, there was a lot of change, as I said, changing governance, beliefs, strategy, no more silos. They've had to go through a lot of change, and they've responded well to all of that, plus having me.
Fair enough. There's also a lot of change happening in the industry itself. And one of the things that a lot of people talk about these days is AI, artificial intelligence. And I sort of, when I was preparing for this interview, I found an old interview with the AFR. And you said that innovation and disruption were the two most abused words in the industry. Does that apply to AI? What's your view there?
Okay, I read that article, and I reckon that's aged like a bucket of prawns in the sun. I reckon I was wrong. Right.
Okay.
So this is where, you sort of read that and went, oh, I think we are in the age of innovation and disruption. And I severely underestimated, I think that was 2012. Yeah, maybe not. Yeah, a bit later. I think there's been a lot of disruption and innovation, whether it's the digital, whether it's obviously now with AI. I think AI there'll be new versions of energy. There's ways of doing things. There's also some bad disruption in terms of we're in a multipolar world. The cost of warfare has gone down, so the marginal propensity to war goes up. We grew in a pretty balanced world post the war that we knew we had one world, and now it's bifurcating into various regions. And so I think I was wrong. Having said that, is it as innovative as we got the round wheel and introduced fire? Probably not, but the world is changing, and I think we should embrace that. Particularly if I think about Australia and as an allocator, the world has changed since GFC, in some ways not for the better. We have to deal with energy resilience and climate. We have to deal with critical minerals. What does AI do to the workforce? What does it do for people? Who gains from the expected productivity gains? Does it go to capital or labor? If it goes all one way to capital, not labor, there will be riots. There will be a greater disparity in terms of wealth and income. People will be unhappy. There will be volatile elections, social media and the rise of that. So I think there's a lot going on in the world, and we just got to make sure as innovation happens, that the gains are shared.
Do you think it changes as well the asset management game, especially on sort of the active management side, where access to data is easier, it's harder to gain an edge?
So I think the biggest winners in that have been the quant funds and the systematic funds, who are naturally very data enriched and aren't afraid to embrace large language processing models, systems, much more sort of, might be a bit of p-hacking to use the stats term, but there's a lot more sort of mining and using of alternative data. They were much better than the fundamental types. Probably the systematic quants have done a much better job in risk management more than anything else. The risk management's kept them in the game more than, say, the fundamental types. They're learning those lessons. But, when we look at it here internally at Funds SA, and then when we see with our managers, it doesn't matter if it's a credit manager, an equity manager, a passive manager, voting of shares, people are using AI in their business. They're using it initially as a tool. We use it here across. There's a lot of people who are vibe coding, building macros, building things. It's changing. Do I think there's a bubble in parts of AI sector? Absolutely.
Yeah.
Do I understand the valuations of some of these large language models that are burning cash and on record valuations? I do not. There was a shoe company the other day on the New York Stock Exchange that was going, Phil, 99% over time, going bankrupt, pivoted to AI. Its stock went up 5x. Right? Clearly, there's some nonsense going on.
Yeah.
But whenever there's an innovation cycle or whenever there's disruption, you do get, the old manic panic and crashes Kindleberger. One of the bubble things is there's an innovation cycle, and that's part of the game.
Yeah. Yeah, in some parts of the industry, there's a bit of a reminiscence of the dot-com bubble where, you just had to add .com to your company name and, the share price went up. At the same time, you see chips are still, TSMC came out today, and I think they still had a record profit on selling the chips to the AI sector. So there is a real story there as well.
It's a real story. So NVIDIA, the foundries in Taiwan like TSMC, these companies are printing real profits, right? And Google's another one. So it's not bubbles can sometimes be overused, but there's some interesting valuations away from them that it's hard to get your head across.
Yeah, but do you think that shifts the structures in the equity market as well? There seems to be, the size factor comes back, but almost in the opposite way, where large caps are dominating, outperforming.
I think when it gets priced in, and we've had it well priced in, I think there will be again when you get so much. Maybe the value person in me, the valuation dispersion, the opportunity sense will come in. And lately we've seen that with EM bounce back pretty hard. We're starting to see a little bit of, we're certainly seeing a lot of good alpha, but also some good returns out of the small to mids. So, we had the rise of the Magnificent Seven. The first version of that looked a bit bubbly. It sort of corrected, and now we're getting the sort of the AI type plays. It's part of cycles. You can't pick them. You can't pick them on the way up. Good luck picking them on the way down. You just have to be conscious of what positions you take and make sure that at the margin you can sort of lean against it and have opportunity on the right tail in terms of VC or some of these companies, and then on the left tail be diversified and managing your active exposures. I do think the business that we're in of managing capital, whether you're an asset owner or a fund manager, will be changing over the next 5 years.
In what way?
Hard to say how it morphs, but if the agentic AI and the models and you can develop personas and they have memories in those models, do you need as many analysts? Do you need to see? It starts giving you that. So while that rises, you will need the correspondent rise and people almost acting as human whisperers of AI and that output to boards and individuals explaining what that means. So, there's going to be a coincidental rise of those two.
Yeah.
But, the first one has more of an employment impact than the second one.
Yeah, for sure. So we're not at a stage yet where you should just hold passively the top 20 or top 50 stocks and just let them get on with it.
I don't think, passive is a valid part of any portfolio, but again, I'm not a person, full TPA or full passive or full active, you can have it all, right? You don't have to vote against it. But in a default setting where you don't know what you're doing, you don't know where the world's going, sure, passive and systematic will give you that beta exposure, but you probably at the margin can do with a bit of active.
Yeah, for sure. Okay, so you said you were wrong on the innovation and disruption. You've also been quite critical on crypto. Were you wrong on that as well? I think
no, that's a load of nonsense. and the thing, look, crypto, if you want to have it as a digital Ponzi scheme, go for it. Shoot your lights out. Congratulations. But it's not money. That's the thing that bugs me. When people turn around and say crypto, or even the gold bugs, gold is not money and crypto is not money. And we saw that when we went through and with oil and the crisis, the first thing people wanted was cash and they would sell all the other nonsense because they wanted cash. You don't do gold-backed debt. You don't do crypto-backed debt. I'm not, stable, this whole sort of stable area, interesting, the way sort of fintech and that's processing interesting, but there's been a lot of nonsense in that, and you can have it. That's happy to provide the chips and the shovels and the data that they need, but sustainable crypto, give me a break. Your burning energy is already scarce, and what's that used for?
I think you called sustainable crypto a vegan tomahawk steak at one stage.
Yeah, with apologies to vegan tomahawk steaks, which probably, taste a lot better than the rubbish that's built out by some of those crypto types.
Fair enough. Another point of discussion in the industry at the moment is private credit, and we've seen some liquidity issues with some of the funds. What's your view on that? Is that a problem with private credit, or just the wrapper that?
So I should say at Funds SA, we have 0 Aussie private credit.
Okay.
We feel pretty good about that, actually. So 0. We have about 60 basis points of global private credit. So we're in an interesting situation. But we've put on some really well-established global private credit. We've just put on some CLO, equity, both secondary and primary. I actually think the opportunity space looks good for us because we're underwriting into that. We don't have any existing ones. I think some of the commentary written about private credit has come from, it's interesting, you've had all the big, large players in private credit saying, yeah, there are problems, but it's not systematic. Who's on the other side is some sort of global small mid-cap manager who's never done credit in their life saying it's a bubble, it's going to die, right? And so what do they know, right? I mean, the reason they're upset is probably because private credit's up there, sort of higher up the cap structure, getting the returns. But don't believe private credit per se is the SPV of non-recourse real estate debt of 2007 that's going to cause some sort of crisis. Banks, private credit managers, long-term, sort of locked up capital that does this will make sure that the system does what it has to do. Are there problems? Yeah, one of the big problems is that there was a lot of these BDCs, and when you have a listed entity with unlisted assets and you offer a liquidity redemption window, it's always the same thing in any crisis, in any dislocation. It's either leveraged money or money that's not there for strategic reasons that wants to depart. That creates the opportunity for others to come in and take advantage if they have to sell at a discount.
Yeah.
Now, are there private credit loans or issues, whether it's been in SaaS software disrupted by AI or frankly bad lending? Of course there are. Are there in 5,000 equity stocks in the global capital market? Are there 50 or 60 that are in big trouble, or 70 or 80 that could be in fraud? Of course they are. So, you're always going to have problems, right, in loans, but is it a big systematic issue other than the retail, illiquidity BDC type or occasionally bad loans? Sure, but I don't think it's a systematic issue.
Do you see it potentially as throwing up some opportunities for a fund like you?
Oh, yeah. We're taking it as we speak. We're allocating to special sits managers or people who can provide capital and solving for the opportunity. And again, we've come in underweight. So I should be saying private credit's really bad, but I just don't believe it is, Ben. Yeah. And we'll take advantage of the opportunity across our manager set. We're pretty excited by it.
Yeah, fair enough. So going forward, what's on your agenda for Funds SA? Is there still a lot to do in the portfolio?
So I'm pleasantly surprised how well the performance has been. We're off to a really good start. Again, strategy, governance, team, Jana, non-silo. I really would love to have the third fund I've worked for to continue to have, very lucky at Statewide, first quartile. Hostplus is a machine, right? I still speak to some of my old colleagues. That is one of the great funds, and will continue to do well because it knows what it's doing.
Yep.
We've turned it around here at Funds A, and my focus is to keep that turnaround. Really happy where we are, but this is like a cricket game, right? It only takes one bad ball and you think you're going to slug it and you're bowled and you look like an idiot. So happy where we are in the process. Early days, very early days, but we've got to maintain that focus. Managing portfolios for our clients and members is a privilege, and we just can't stop. We got to be on the game and making sure we're aware of what's happening.
So you mentioned Hostplus. When you look at Hostplus, it does really well, but it also has a very clear sort of target client base. They're young people. They have a long runway, so they can take a lot of risk. which has led to the asset allocation that they have. I think at Funds SA, it's probably much more of a mixed bag in terms of the demographic of the member base. Does that make it more difficult to set a strategy?
Yeah, so Statewide also didn't have a lot of cash flow, right? So being a smaller team, the unique tax advantages and obviously the not being regulated by APRA, and the setting up the governance structure, I think gives us, and being 50 billion and not 500 billion, and not trying to manage really large cash flows, it allows us to be a bit more nimble and take advantage of the opportunity should we get it. And so like last year, all of Funds SA, whether it was the investment team, the finance and ops team, the legal and ODD, we've had a couple of opportunities and we turned them around, going through the process, investment committee, negotiating commercials, operational due diligence, commercials, and we can turn around there's one we turned around in 8 weeks.
Yeah.
And the manager said, we've never seen this before, and they manage some sovereign wealth money and some large pension fundies. So having the ability to invest, sticking to your beliefs, I think is a core advantage. One of the questions I get asked a lot, and I think you were going to ask me, is, what's the best investment you've made in your career? It's the people.
Yeah.
It's the people. So being surrounded by a really core bunch of people that you can trust. I had that at Statewide. I had that at Hostplus. And we're building this at Funds SA, a core bunch of people close to your consultant, close to your investment committee and board, and being on this and being committed and not stopping, like being at it, just focused on doing this. That doesn't worry me because I think we know what we're doing and it's starting to show in the results.
Yeah, for sure.
And you can be nichey. We can do a 20 or 30 million VC and 20 or 30 million co-invest at our size, and we can do a couple of these. But if you're 300 billion or 150 to get access and to do that, it's much harder.
Yeah.
And just sizing that and taking advantage of that opportunity set, I find it easier to run less money than more money.
Yeah, for sure. Now, usually I don't let people get away with just talking about their best investment. Can you tell us what was your worst investment and what did you learn from it?
My worst investment, what did I learn from it? So throughout all the career, probably single strategy hedge funds was the worst investment. I'm not going to name names, but at Statewide, we had single strategy, and they're all great big names, big personalities. They promise you diamonds and they give you rocks. Right. And we moved away from that at Hostplus. And this is, again, the importance of working with great people. There's Greg, Sam, and myself. It was Chris when I was at Statewide, and Dan, who's it continued at Hostplus. And it just wasn't working. We moved with Jana to a sort of an allocator model where they were closer, they could implement, they could do overlays. That was Blackstone. Here at Funds SA, Peter, who runs the alts team, has moved from those single strategies to Man and Blackstone. They're highly specialist. They know what they're doing, and it's worked very well as opposed to trying to manage these on your own, which are really difficult.
Yeah, I can imagine.
So I gave you an investment and the asset class, but so far it's turned around. I feel good about that. The other one was, I remember going down the rabbit hole on tail risk.
Yeah. Was this the crisis mitigation stuff? Or?
Yeah. And, you put it on, it works until it doesn't, and then it doesn't work, people lose, and then you take it off. And, we never got to invest, thankfully, at Statewide and Hostplus, and we had a tail risk here at Funds SA, and we took it off, and we put it to productive capital that can make money. Because remember, you are diversified. The one thing we spend with members is take a traditional balance fund. Equities are down 8-9%. You're about half in equities. You've got fixed income cash now. When bonds move away in a stagflation, that could hurt. You've got a bunch of infrastructure and property. Real assets tend to do okay. So you don't feel the full effect of that. That's the beauty of diversification. And you know, you have to remind people. So the idea that I'm going to, and I'm sorry to tell him, and I hope he doesn't call me, you know, idiot, moron, imbecile that he does, but it's just too hard.
Yeah,
To be fair, and to be fair to him, he does say you should be invested in equities and have this.
Yeah.
Well, we just do balanced funds. We've got high growth funds, balanced funds, conservative funds. You have the journey for a member. We've got different tailored solutions for clients. So sticking to your strategy and being diversified works.
Yeah. Now, we might finish up with a bit of a personal note. I think a lot of people, apart from, of course, knowing you as CIO, also know you from your Twitter feed, where you put
I've locked it now. So now, or you probably on there, so you still see it.
Yeah, I actually do. But, you know, you got a lot of opinions on there. What do you see of the role of that? And do you use Twitter as well for, you know, getting some market insights?
Well, you get a lot of information very quickly. You also get, unfortunately, a lot of fake information.
Yeah.
But I remember many years ago, I did an interview with the advertiser on this. It started off with football and music. It just morphed into Fin Twitter back in the glory days, which was pretty bare knuckles and fun. I've actually met a lot of people through that, have met them around the world. You've met interesting people. You then go to private sort of messaging. So just got to, it's like anything in life. You use it for good, you can use it for bad, use it for noise. Mine's more selective.
Yeah. You say it started with music, and I saw some of your comments are around Joy Division, punk music. And I was looking at that. I'm like, that's not your standard business school playlist. How did you come to that?
But you'd be amazed. Our chairman famously was interviewed, and he's a big punk rock.
Oh, really?
So guy, you know, he'll wax lyrical on Husker Du or
really?
or the Pixies. My old co-deputy CIO, Greg at Hostplus, we could lose 3 years just talking about Nick Cave or Joy Division. So no, you'd be amazed. You'd be amazed how many people come out of their shelf when you start doing the music. You'd be, it's more diverse than you think.
Oh, good.
Including the metal types. You'd be amazed how many metal types. I'm not going to out them, but there's some really crazy ones out there.
Fair enough. No, I looked at it and I'm like, oh, I can now safely bring up my final record collection at some stage, which features a lot of punk. But we'll leave that for another time.
Good. It's fun.
Well, Con, thank you very much for this conversation. It was a lot of fun. And yeah, thanks for your time.
Cheers. Thank you. It was good fun. Thank you so much.
All right. Thanks.
Bye.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3, -invest.com. And don't forget to like, subscribe and review. Thank you very much.